I'm Neil Giuliano with Greater Phoenix Leadership. On behalf of Pam Kahali, our board chair of Greater Phoenix Leadership and the president and CEO of Blue Cross Blue Shield of Arizona, and our GPL Economy Task Force co-chairs, Kathleen Walker, regional president of PNC Bank, and Ray Shea, the publisher of the Phoenix Business Journal, we want to welcome you all who are gathered here, and also welcome all of you who are watching via simulcast to this very important conversation with Mary Daly, President and CEO of the Federal Reserve Bank of San Francisco. We have a few elected officials here with us this morning. We don't need a rounding room of applause or anything, but I want to thank them for attending. Arizona State Senator Brian Fernandez from District 2, Arizona State Representative from District 12, Stacey Travers, and one of my political heroes, Maricopa County Supervisor Bill Gates. We also have representing Congressman David Schweikert, his Chief of Staff, Kevin Knight. And I want to make a special thank you to Paul Hickman, President and CEO of the Arizona Bankers Association, for his support promoting this event to his very important constituency. So thank you, Paul. We sure live in fascinating times, and the timing of our gathering could not be more interesting. With the decision by the Fed earlier this week to hold interest rates steady but pencil in a plan for a rate hike later this year, the Wall Street Journal offered a headline of, "Why a Soft Landing for the Economy Could Be Hard." So to kick off our program and to introduce both Mary and our very special guest journalist, it's my pleasure to introduce the chair of the board of the Los Angeles branch of the Federal Reserve Bank of San Francisco, and the chief executive officer and board member of Sprouts Farmers Market, and proudly a member of Greater Phoenix Leadership, Jack Sinclair. Welcome, Jack.
Thanks very much, Neil. It's kind of interesting when three worlds collide. GPL, Sprouts, for all of you in the Arizona community, so such a great supporter of Sprouts, and it's great to be here representing the Los Angeles branch of the Federal Reserve Bank, which is a very interesting and rewarding assignment, and if anyone gets the opportunity to do these kind of things, it's a really interesting opportunity to really understand what's going on across the economy from a kind of observer seat as much as anything else. The Fireside Chat's going to be led this morning by Russ Wiles. Now, Russ Wiles is the Arizona Republic business reporter and is very well known to the community here for his years of service to the Arizona Republic. So delighted to have Russ here this morning to lead this Fireside Chat. And it gives me great pleasure to introduce Mary Daly, the leader of the Federal Reserve Bank of San Francisco. The San Francisco Fed is the largest Fed in the country, covering a huge proportion of the United States, and Mary has a big responsibility there. She's been working at the Federal Reserve since 1996, hailing from St. Louis, Missouri. She's got an illustrious academic background, if you read her background in terms of the degrees that she's got in the illustrious university she's been attending. So that set her up for a 1996 joining the Fed Reserve, and she's been there ever since. And she has got a capacity, as I watched from afar a little bit, a capacity to make some of the complex issues facing the economy really quite simple. And that's been some of the feature of her, that's the context of inflation, which has been so rampant over the last couple of years, the context of economic stability, the context of monetary policy and the role that monetary policy can play in stabilizing our economy. She brings a capacity to bringing a real simplicity to that. And as a banker, she's unusual in many ways in that she's vulnerable, considerate, optimistic, pragmatic. So for any bankers in the room, apologies for that, but Mary's pretty unique. Mary's pretty unique amongst the banking community. So please welcome our guest this morning. I'll pass it on to you, Russ.
Thank you, Jack. Well, Mary, interesting times in the economy. The Federal Reserve decision makers met this week in Washington. You participated in that meeting. Could you talk a little bit about, what the thinking was there from the outsiders? It didn't look like there was any change in the status quo. No interest rate increase announced, no rate cut. Now, what does that perhaps imply for the future of the economy, maybe even a soft landing?
Sure. So let me just start with the decision we took. So in case you hadn't seen in the headlines, we decided to leave interest rates where they are. We can call that hold steady or stand pat. But the reason we did that, in my judgment, and here I always speak for myself, not for the committee. That's how the Federal Reserve works. So I can tell you more about that later if you're interested. But seriously, back to the question, the decision to leave rates where they are is really one of recognizing that we've been really rapidly raising interest rates. And it was, we got closer to the destination being where we would be able to hold them steady for some duration in order to sustainably bring inflation back down to 2%, which, as Jack said, has been rampant. Inflation's been too high for too long. We need to get it back down to our price stability goal. Then we hold rates steady so we have more time to collect the information we need to see if more is necessary or if we can simply hold where we are. So what we did at the meeting this week is not a predictor of what we'll do at the next meeting. It's just a sign that as we get closer to our destination of where we'll peak the rate, we need to go at a slower pace so that we have more time to collect the information. So what information do we collect? Well, we're really looking at what's been a very good set of news data points in the last several months. Inflation is coming down. And first and foremost, I want to point out that that is a relief to households and businesses and communities who've literally been struggling for over a year or a year and a half or more with high inflation. So this is first and foremost a relief to those individuals and those families and those businesses. But it's also very important for us achieving our goal. So having that inflation come down is what we need to see in order to think that we're getting on a trend to relieve us of this inflation and get closer to price stability. The other thing that's been our commitment since the very beginning of our tightening cycle has been to bring inflation down as gently as we can. And what the news about the labor market's been showing us is it's gradually adjusting rather than abruptly adjusting and causing a large spike in unemployment. This is unequivocally good news to have inflation coming down and having unemployment come, the labor market slow gradually. And that's where there's a lot of discussion about a soft landing. But I will tell you that as a Fed official who is really thinking about the future, I do not get to a point where I'm ready to declare victory. What I'm really ready to do, and what the meeting signaled for me, is there's a lot of information we need to collect. We will not be satisfied that we are where we need to be until we see inflation confidently. We're confident that it's on a path back to price stability. Because the American public, as much as they're getting relief, you all didn't ask for us to just get a little relief and call it a day. You really asked us to do our jobs, which is to bring inflation back down to 2% and as gently as we can. And that's what we're doing. And that's what the meeting signaled.
So you mentioned inflation, you mentioned labor. Any other data points that you kind of focus on?
So those are our mandated goals. Congress gave us 2 mandates, price stability, full employment. So that's why we focus a lot of our attention on those. But of course, to understand how the economy is going, what the momentum is, you have to look at a variety of data. So the dashboards of data we have are very wide. They have a lot of information on them. I have to have many terminals so I can keep track of it all. But the piece that I think many don't know about the data, so you can think of all the published series we look at, but data is a plural word, and it doesn't just mean you look at published releases that you wait for, because often those are backward looking. We also come to our communities, the communities we serve across the country, and we ask people, what's your lived experience? What's the lived economy really feel like right now? So we do a lot of sourcing. I'll have a CEO roundtable later today. I met with students earlier. I'm asking people, what is your experience in the economy? And if you're a business, what are you really thinking about for the future? What are you going to do? Are you hiring? Are your input prices falling? Do you think you'll pass price savings on to your consumer? How are you seeing demand? These are all the pieces of information we need to really gauge how much momentum the economy still has, and importantly, would another rate hike be necessary, or can we hold the rate steady where we are? We do not know, and it's okay not to know. The thing that would be a problem is if we decided that we wanted to call it done, we say we're done, or we say definitely one more when we actually don't know. Patience is a prudent strategy right now, and that's what we're bringing to the table.
You mentioned talking to people. The San Francisco Federal Reserve District, the largest geographic one in the nation, stretching from Arizona to Alaska, Utah to Guam. How much traveling do you do, and how do you converse with individuals, businesses, consumers?
I do a lot of traveling. And it's funny, I was telling my team yesterday that when I first came and joined we had a leadership conference, I was telling my team that when I first joined the Fed, I wasn't sure about taking all these small planes. I came from St. Louis, I got on a plane in a big jet, now I'm in these little regional things. But you really have to decide that if you want to be with people, you've got to learn how to fly in those little planes. So now I fly in those little planes all over the place, and the big planes too. And I think it's really important, that's just an aside, but why is it so important? Why is that a necessity? Well, we need to understand how people are experiencing their economy. And you can read things, but it's not the same as going places and interacting. I will also say that if you had to rely on me to go to all the places in my district as the only source of information, I couldn't do it, right? It's just too vast. So we have teams of people who are out in your communities. We have a location here in Phoenix. We process cash here, but we also have people from our community development and business development group. We have business outreach here, and we have members on our boards of directors who come from the area, and that's another way we source information. So we're out there sourcing information from the whole district all the time, even when I'm not physically there. And then, of course, the virtual environment that we all learned so easily to use after the pandemic has been a tremendous addition to my portfolio of how I can collect information, because I can put a virtual event together if I need to understand something and have these roundtables with community leaders, CEOs, worker groups, and say, what's really going on for you? And those have been a huge benefit and helped me, really build up my group of data that we need when we're in such an important part in the economy.
But you're not taking a small plane to Guam, right?
No, that would be the big one. The kind that I'm actually like, oh yeah, okay. But
Can we back up a second and maybe just talk a little bit about the Federal Open Market Committee, which is the big decision-making committee of the Federal Reserve? You're a member of that, a participant. Could you talk a little bit about how it works, even the discussions? What's the atmosphere
yeah, sure.
in these meetings?
So it is probably different than people imagine. I'm assuming it's different than people imagine, because when I tell them how it really works, they're like, really? So here's what it is like. We all work with economists. We all are looking. There's 19 of us, right, which includes the chair. And every one of us is studying, thinking, talking to people, bringing perspectives, talking with teams. So we have analysis, we have data, we have research, we have models, empirical information, and the regional Fed presidents have a lot of what we call outreach, public engagement, where we're going out there and we're actually hearing from people. So then we all come with that information and we meet. And when we walk over the threshold that is the room of the FOMC, there are no politics, none. So there's not lobbying for a position or any of that. There's simply, how do we see the information we have before us? What do we think is the best way to achieve our congressionally mandated goals? And how can we debate, discuss, have differences of opinion, but we're all about a single thing. So the thing that I love about the FOMC is there is absolutely complete agreement on what our mission is. Serve the American people by achieving our congressionally mandated goals of price stability, full employment. And then doing our very best with our data, our analysis, and our discussions to ensure that we get that result right. There's been this whole discussion lately about, is there too little disagreement at the Fed or too much disagreement? It's an interesting thing, because if you're in the FOMC, what you notice is that there's a constant level of debate, discussion, disagreement, and all actually doing it for the same reason. When we find that we're unified in which decisions to make, it's usually about the economy. So when the pandemic, there's little disagreement about what policy actions to take. We've got to reduce interest rates and support the economy. When inflation's at 7%, there's no disagreement about what actions we have to take. We have to raise the interest rate to get the economy to slow down, to get supply and demand back in balance, and to get inflation to fall. So that's why decisions look so unanimous, because they are. But when the discussion that underlies them is not one where we're all just saying, oh yeah, that's all we want to do. We are actually robustly debating and discussing these. And that's what you deserve. As people we serve, you deserve us to always be bringing our best, really understanding it, really discussing and debating, and then coming up with an answer and a policy decision that we also have to have humility about the minute we take it. So I have a sticker I just gave to the students. It says, because this is the way I think policy should work, be curious, voraciously curious, bring your best work, be confident in the decision you make, and the minute you make it, be humble about what more you need to learn so you can start the process again.
Mary, you're a labor economist by training, I believe. I don't think there's been anything more confounding, amazing, whatever word you want to use to describe the labor market. Despite all these interest rate increases, signs of some slowing in the economy, unemployment has been very steady. There's a lot of jobs unfilled. There are a lot of, even in the Metro Phoenix area, there's a lot of companies hiring now for the holidays. What do you make of all this?
So what I make of it is that the economy has a lot of momentum. So as you know, employers don't hire workers or put ads out to hire workers unless there's demand for their products. So the demand for products, whether they're goods or services, has just been something that is remarkable in many ways. I mean, someone asked me, what's the most surprising thing after the pandemic? The sheer momentum of the American consumer, just being willing to be out there. And whether you call it pent-up demand that they had because we were all home, or just an unbridled enthusiasm for the future, people want to be out there. They want to be spending and participating and partaking of the things that give them joy and make their lives happy. So that's what we're seeing. And then, of course, employers want to hire workers. So that's the demand side. A lot of it's being driven by the demand side. But, of course, we had supply side issues, too, with workers. So a lot of workers withdrew from the labor force during the pandemic for a variety of reasons. And now we're just seeing them come back. And what's really nice now is those workers are coming back, and we are getting the supply, we would call that the supply of workers, is improving. And those two factors together, demand is starting to slow as we raise interest rate, and supply is improving, have started to close some of the gaps. So the number of openings per unemployed worker is still high, but it's fallen quite considerably over the last 6 to 8 months. We've also seen the job growth come back more in balance with the available workers. So every month we add about 100,000 new or re-entering workers to the labor force. And job growth was, 300,000 plus. And so that's a huge gap between the jobs being created and the number of workers coming in to take those jobs. Now it's 150, about 150,000 jobs per month over the last 3 months, and we still have this 100,000 workers coming in, so the gap is narrower. So we're still not in balance, but we are in a place where the labor market is slowing, coming back in balance with an increasing supply, and those are both good signs for the economy. But I'm just really, you're right, the labor market has been exceptionally strong, and I said that inflation coming down is really good for American families and communities and businesses. Well, the labor market being strong is really good for American families, consumers, and businesses, because it ultimately fuels that dynamic, that virtuous cycle that we would all like to keep going.
Let's talk about inflation a little bit. A year ago, last summer, it was running 13% in Phoenix, and I think it peaked at 8.7% nationally. Both rates have come down to about 3.7%. I mean, almost 10 percentage points in Metro Phoenix. I assume that's a sign of the interest rate policy working. And it's been about a year. Is that fairly normal?
That is fairly normal. So monetary policy acts with a lag. And you can imagine this is true. So financial markets actually react right away. So we say we're going to raise rates, and then we put out the summary of economic projections and signal the path is going to go up more, or communicate that. And interest rates move pretty quickly. So if you remember, the mortgage interest rate rose in the fall of 2021 after we signaled that we were going to start tapering asset purchases more quickly than we had planned, and planned to raise rates earlier in the following year. Mortgage interest rates rose immediately, and the housing market started to get that in there. But it takes a while for that to trickle through or move through the pipeline and actually affect real activity. And so right now I do see signs that demand is coming down in reaction to our interest rate moves. I also would offer, though, that part of the gains we've been getting on inflation, part of the decline, has come on the supply side. Supply chains have really improved. If you look at most indices of supply chains, they're really back to their pre-pandemic levels in terms of normalizing. We visited the port earlier this probably a month ago, Port of LA, Long Beach, and we saw the containers are moving through regularly. There's not the big stockpiling of containers waiting to be getting on trucks. So that port clog has been eliminated now, and things are improving. So I think all of that, the supply improvements and the demand slowing, are creating the opportunity for inflation to come down and things to get more in balance, which of course is a terrific relief. Now here in Phoenix, when I pour over the data for the district, one of the things that was true in Phoenix and is true nationally as well, but I really saw it in Phoenix, was the housing prices were really going up at a rapid clip, and that housing price inflation has come down. That is a direct effect of the interest rate policies, which of course try to bring demand more in line with supply, and then builders can continue to build to bring that fully to a balance.
Let's talk a little bit, something else about Phoenix. You mentioned the cash processing facility here in Phoenix. Nevertheless, Phoenix is the largest metro area, I believe, in the country, with neither a Federal Reserve bank like San Francisco or a branch like Los Angeles or Salt Lake City or even Helena, Montana. I mean, are we missing something here? And why don't we have a bigger?
Yeah. So
why don't we have a bigger Federal Reserve?
This is where it's a good question, but let's go back to history. So the Federal Reserve was put into place in 1913. So in 1913, Phoenix wasn't really on the map in the way it is today. I think you would all agree with that.
Right.
So the geographic distribution of offices and even the districts, I mean, I didn't used to have, if I had been alive in 1913, I wouldn't have the most populous district in the country. I'd have, they divided them. There's 2 Fed Reserves in Missouri, my home state, Kansas City and St. Louis, and that's really because the population, remember, didn't go much east of or west of the Rockies, and so that's the distribution we have. So then the question is that a barrier to us collecting information, for you all here, living here to have a voice and for us to understand the experiences? So one thing I will offer is we do have a cash processing facility here, and one of the reasons we do, that was built only about 20 years ago. Why? Because Phoenix is a very rapidly growing metro area, has a tremendous population, and we needed to be able to service the cash needs of individuals living here and around here, so we built a facility. We also have, so we have employees, we're part of that. We're part of the greater Phoenix community, but we also have members of our boards of directors and our councils from the Phoenix area and from Arizona more generally, and that has always been a feature of the Fed since I've started, but long before I started. It's to get that geographic distribution. We also have a community development leader here who works with communities and community banks, and then we have a business development leader here who works with all of you and actually helped in putting this event together with GPL. So these are the things that we actively do, and so that we feel like we're getting the information we need. And of course, you know where I am, so feel free to reach out if you think I'm missing something about the greater Phoenix area or Arizona in general.
Speaking of banks, we had 3 major bank failures earlier this year. The Federal Reserve does keep a close eye on banks. 2 of those failures were in your district, and I believe First Republic and Silicon Valley Bank are really just a long BART ride from your offices. Can you talk a little bit about either those banks in particular or just the stability of the banking sector right now?
Sure, and I'm going to start with the question that's literally the most important for Americans, whether they're business or households, is my banking system safe? Is the banking system safe? And it is. It's safe, sound, and resilient. And that was said by Chair Yellen, she used to be the chair of the Fed, yeah. Treasury Secretary Yellen. She's a friend of mine, so she'll forgive me, I think. But Treasury Secretary Yellen, the chair of the Fed, Jerome Powell, and Marty Gruenberg, who's the head of the FDIC. So they went out right after Silicon Valley and Signature Bank failed and said the American banking system is safe, sound, and resilient. And we are doing what's necessary to ensure that's true. But the other piece of evidence I would bring to you is we have over 4,600 banks in the United States, and 3 failed.
But they were big ones.
They were big ones, but that's the size of the activity. But the important thing is the banking system didn't falter because those 3 banks failed, even though they were large. They did not falter. It stayed sturdy. Americans and businesses in particular and families continued to get credit. Of course, we see banks tightening credit. Their loan volumes are going down, their credit standards are tightening, but that's what we want banks to do. That's how monetary policy works. We raise the interest rate, they manage their balance sheets, credit tightens, the economy slows, and we get the drop in inflation that we need. So that's actually how we want the system to work. And the bank failures, I would say, what I would offer is, we had 3 failures, but the rest of the 4,600 banks, they kept going, and they kept doing the important work that they do. And again, most of the banks, 4,600 banks, 3 of them failed. Most managed their risks very well, were effective, were well capitalized, and could manage this transition through the higher interest rates and into a different world as we bring inflation down. So I think this is you look back on it, it is a story of bank stresses, and that's important. We'll learn lessons from that. But it's also a story of bank success and bank strength, because they weathered that storm, made it through, and continued to do the job that they're asked to do.
Are there any sectors of the economy that kind of keep you up at night? I mean, commercial office buildings kind of comes to mind, maybe?
It does come to my mind. So commercial real estate is one of those sectors which, I think we say commercial real estate, and then people say, oh yeah, it's terrible, it's scary. But I think it's really useful to unpack commercial real estate into the component parts. So we have, of course, office buildings. Well, everybody knows what happened in office. We used to go to work 5 days a week, everybody did, and now we're in various stages of hybrid. So less office space is being demanded, and that is a hit to office space. So the second part of commercial, though, is industrial space. And that industrial space is in high demand. When we moved out of offices into our homes for the pandemic, we started wanting a lot of things delivered to us. And industrial space is hard to come by in some sectors because there's a lot of shipping and distribution and warehousing that's needed, and that's being built. It's not being destroyed. So industrial space, light manufacturing, that's all still in pretty good demand. And so that's a strength of the commercial real estate sector. I'm not saying it wouldn't slow, but it's not like office. And then, of course, we have retail space. And for the longest time, we were talking about how retail was really going to come down. And the interesting thing is we had a roundtable on commercial real estate, and people are kind of more bullish on retail real estate than I would have thought. And so that's that's something to watch as a potential strength, or at least study in the boat. So when you think of commercial real estate, I really dissect it into office, industrial, and retail. And then the other thing I've learned mainly from traveling around is not all office is the same. A lot of it, doctors, lawyers, other in-person services, they're still going to the office, and they need office space. It's those, in San Francisco, you see this, really tall office buildings which used to have, fintechs or tech workers and other things in, and they're not coming back to work in any number. And so that's a sector that you have to continue to watch. And it does keep me focused on what's happening in that sector.
Well, speaking of technology, my next question, I don't think anything has been bigger this year than artificial intelligence. What's your take on that, for good, for better or worse? And is the Fed using AI?
So there's 2 types of AI. And right now, people are, I think, conflating the 2 terms a lot. Not necessarily anybody in this room, but they get conflated a lot. There's machine learning, which we've had for a long time. And many companies have used machine learning. It's just being able to use a machine to scrape text, to figure out things. I mean, a lot of that has been done for a while. And so researchers do that, right? They use that to look at sentiment indices and news stories and things. So that's there, and is being used for a variety of things that you're all familiar with. The new piece of this is this generative AI, that AI can be used to generate things. And so generate things like scripts that writers wouldn't have to write, or generate things like essays, ChatGPT, everybody's using it to write things or to figure out what to code. So that is the new technology, and it's definitely a hot topic, and it is definitely an open opportunity for many people, many types of things you can think about doing with it, but it's small right now. We had the chief economist of LinkedIn. We did a LinkedIn Live with our director of research and the chief economist of LinkedIn, and we put this question to her because she sees all the data on job postings and hiring. And she said a very fast-moving sector, but still very, very tiny in the scheme of all the jobs being thought. So how I'm thinking about AI now is let's understand its uses, let's understand its potential impacts on productivity. The researchers are coming out on both sides right now. Some researchers say this could really change productivity, it could really improve our potential output growth in the United States, and others say it's going to be disruptive. My view is both are true. It's going to be a disruptor that eventually could have benefits, but we have a lot of things we have to think about right now, and that's sort of where the Fed is. We always look ahead at what things could be disruptive and reallocate activity, and what things could improve or diminish potential growth or the labor market. And so that's the Fed, how the Fed's using it right now, is students of these technologies and how they're being used, so that we can continue to do our best jobs on full employment and price stability.
We talked a little bit about industries or sectors that might be a little weak right now. Are there any geographic regions, or at least pockets in your territory, that kind of worry you?
You know, here's something that I see from traveling around, is that the pandemic was a tale of two economies. We always have inequality in the United States, but that really showed starkly that if you had to do in-person work and you had to manage yourself in the pandemic, that was harder than if you were told you could stay at home and they sent you computers in the mail and you did that. And so that tale of two economies has still persisted a little bit because of the high inflation. So yes, low and moderate wage workers have more job opportunities than they had. That's been a strong point of job growth. But inflation, if most of your income goes for food, housing, transportation, clothing, the basics, the essentials, then you've really struggled. So instead of geographic areas, what I see is the distribution of pain and hardship that is really tilted to those least able to bear it. And that's one of the reasons the Fed remains so committed to bringing inflation down. Because while 3.5–4% might be fine for certain individuals and groups, it is not. It's not our goal. That's the first and foremost. Our goal is 2%. But second, it really takes a toll on families who are really trying to manage and keep their wages at least at pace with inflation.
And you had mentioned housing inflation. Any other subcomponents that kind of worry you, or concern you? I mean, food, for example?
So food, after food inflation was so high, it's come down, which is a huge relief. Energy prices are going back up, which means that gasoline prices are going back up, and so I'm watching that. While it doesn't feed usually into our underlying measures of inflation unless it persists, it still is a hardship to families and even small businesses who have to pay for those higher costs. So I'm really watching those things. I mean, one of the things we watch at the Fed is we break inflation down into look at core, so that takes out food and energy because those are fairly volatile. So we look at goods price inflation, housing price inflation or shelter price inflation, and then all other services. And one of the things that's been sticky is this other services, not housing. So housing's come down, goods has come down. Other services remains sticky, hasn't been giving much relief, so I'll be watching that as well.
And some of it's cyclical. I mean, years ago, medical inflation was high. Now it seems to be very much
But we've got to watch that because, of course, it's not really something that's interest rate sensitive. It's something that's legislation and policy sensitive.
Well, any other general comments before we open it up to some questions?
Well, I think that the only general comment I will make is that the news we've been getting, and I started with this, the news we've been getting is unequivocally good. Inflation's coming down without a large disruption in the labor market. But it is far too early to declare victory. We really, as a Federal Reserve, have to keep our eye on our job and ensure that Americans can count on inflation coming down to 2% over time, and we'll continue to do that as gently as we can.
And from what I've read, that could endure well into 2024.
Yes, absolutely. We won't. I think it's unlikely we'll be at 2% in 2024, and if that happens, that's fantastic. But we can't count on that. We have to keep our work. We have to keep to our work to get the job well and truly done.
Okay. Can we open up to some questions? Transition to the question and A section? Because I'm out of questions.
I am sure that's not true, but you're being gracious to the audience.
Just last night, I was at an economic forecast given by ASU Professor Steve Happel, and I'm sure a lot of people here have heard Happel talk. He asked rhetorically to the group, and this was the Risk Management Association, why 2%? Why not 1? Why not 0?
Sure. Absolutely. It's a great question. The first question I asked the president of the San Francisco Fed when I came to work there in 1996, his name was Robert Perry, was why 2%? Why not, 1 or 0? Now, we didn't have a formal inflation target then, but we had sort of an implied target of 2%. But then Michael Boskin, who was a professor at Stanford, he ran a commissioned by the government to do, it was called the Boskin Commission. It was working on what is the right level of inflation. And it really is about, you don't want to get into a disinflation or a deflation scenario. So if you make inflation 1% and there's any mismeasurement, you could end up being in a situation like Japan has struggled with, where you just can't get, deflation is very bad for the economy, just like too much inflation is. So 3%, well, that's a point where, mentally, 3%, ultimately the economy could adjust to that, but 3% is not a place where most people will ignore it. So 2% is a place where you get enough buffer that you're not always struggling to protect yourself from deflation, and you have it so that people don't have to attend to it. So when we had 2% inflation, 1.8% inflation, most people didn't think of inflation. I would go to forums like this, and people never talked about it because they didn't have to think about it. They could make their choices about what they wanted to do with their career, how they wanted to spend, completely not worrying about that. They were worried about other things. Now, I can't go to a forum like this without the first several questions being about inflation because people have to think about it. So now that we've set our 2% goal, we are committed to achieving our 2% goal, but I would feel reluctant to move the target below 2% because that would unravel that buffer, and we know what can happen in those situations. And then I'm completely unwilling to entertain going above 2% at this point because we set a goal and it's not credible to move the goalpost while you're midstream. We don't do that in sports, and we certainly shouldn't do that in monetary policy.
While we wait for another question, come on up to the mic. But historically, hasn't U.S. inflation been closer to 3%?
No, it's been closer to 2%.
Has it? Okay.
I would be interested in your opinion about how you assess the risk of stagflation, looking at right now the sticky core. And when we talk to some suppliers, we say they see it's a structural change of supply, so that may be more sticky than, or longer sticky than we want to. And looking at all the forecasts of shrinking economy next year and after, like GDP at 1.456. So how do you see the risk of stagflation, not just for a shorter period of time, but actually for like 2-3 years staying in there, given these two factors?
Sure. So that stagflation would be, we have a low growth, higher unemployment, but we have high inflation, right? And so certainly that was in the risk set. And when we, a couple of years ago, when we were worried, would supply chains recover? Would we be stuck at a low growth scenario? But one of the surprising things of this recovery and expansion has been just how durable GDP growth has been. That's supported by the resiliency of demand, and then supply chains have improved. If you look at any of those indices, they're coming back. So does that mean there won't be some restructuring in the world, in the global economy or even national economy that would limit that complete growth? It does not rule that out, but so far I haven't seen a tremendous amount of evidence that there are structural impediments to us continuing to grow. And in fact, so what are the main structural impediments that get mentioned? One is that globalization's over because of the pandemic, and we've moved to things that will interrupt that. But trade is still active. And there was a paper that was presented at the annual Jackson Hole Conference in Wyoming, and it was about trade, and it showed that, yes, there is nearshoring, there is friendshoring, there is reshoring, but there's still active trade. And you can see that if you go to any port in America, that we're still trading. So yes, it's something to watch, but it's not something to count out. The second structural impediment was labor supply. And people looked back right after the pandemic and said, all these workers have retired, other ones don't want to work, they're not coming back. We'll look at labor force participation now. It keeps surprising on the upside because we have more and more workers joining the labor force, re-entering, and that's very good news. And then the third impediment was people were talking about productivity growth. Maybe it's just going to slow, it'll be sluggish, we'll get stuck. But honestly, productivity growth is starting to improve. So, and we just talked about AI and other opportunities for people to bring in new technologies in firms. I'm more bullish on the innovation of our economy, the ability for people to bring their best ideas, to finance their ideas and get things done, and that would be continued growth. And then we bring inflation down, which is coming down rapidly, and a lot of the relief we've been getting is on goods prices, and that's because of the supply chain recovery. So we shouldn't rule any of the risks out, of course, continue to study them, but relative to where you would have thought that risk was a couple of years ago, I think the economy is proving that risk to be less important.
And I'll admit I'm old enough to remember the stagflation of the 1970s. Another question?
You mentioned a threshold that you all step over, and once you do that, the political dialogue ends. I'm wondering if that threshold could be moved over to Congress. Is that possible? But along those lines, how does an impending government shutdown affect how the Fed is looking at the economy?
So, you know, this is where it's really important for me to say, because it's really true, but people don't always know it, that we don't have any role to play in the government shutdown or in anything that the fiscal agents debate or discuss. Those are jobs for our elected officials, and what we do is make monetary policy with the economy we have. So we assume in this, we watch this, of course, but we assume that ultimately our elected officials will do the thing that's best for the economy and the government won't shut down. And if it does shut down, we are prepared to continue to do our work to the best of our ability and do whatever it takes to ensure that we're achieving our goals, which is, as I said, price stability and full employment. So that's how I think about it. We obviously watch all kinds of risks, but we don't have any influence or decision-making power on those risks. And that's why when you think about a soft landing, to the earlier question, we see the data coming down in a way that might achieve that. But there's all these risks out there that we have nothing to do with that could impinge the economy in ways that we would just have to offset. And so that's what we think about as we look to the shutdown or strikes or geopolitical issues or changes in energy prices. We are the people, the Fed's job is to take the economy we have and ensure that we can achieve our goals. Thank you for the question.
I appreciate your optimism and candor. The saddest day in America is whenever someone gets paid and realize they're still in operational deficit. So as you think about monetary policy, we're seeing that the cost of housing is still high for all. And then though wages are up somewhat, it's not keeping up with everything else. As I landed here in Phoenix, I saw the cost of gasoline was $5.35. That's for the cheap stuff. So what do we tell the low to moderate income folks and those that are hardest hit about the price hikes?
Yeah, so that is the heartbreaking part of high inflation. So I do a lot of outreach where I just go and ask people questions and try to make sure that they don't think I'm strange. But I went to a local giant retailer in Oakland, California, and I asked just customers what were they struggling with. And one young man, he has 2 young children and his wife, and he says, I am on a treadmill that just keeps speeding up and I cannot keep up. And he mentioned what you just asked me. He said, I'm working as many jobs as I can physically do. I have 3 jobs right now. I can't take more jobs. And I'm making more money than I've ever made in my life. And each month, or each week when we come to this retail outlet, we can have less in our cart than we had the week before because the prices have gone up more than my wages. That is why inflation is such an erosive tax. It erodes the purchasing power of people, and it's demoralizing, right? So I see that pain, and it's one of the reasons we're committed to getting inflation fully down to 2%. It's why 3% is not satisfying, right? 3% is a different number for people than 2%. But right now, I'm hearing this more and more, is there's a difference in inflation and the price level. And I was doing a roundtable with workers about 3 weeks ago, and they said, it's true that the price of eggs isn't going up as much as it was, but it's still higher than it used to be. And my wages are what they were when it was cheaper. And so now, how am I going to make that equation work? My answer to him was, I know this is challenging, but as inflation goes back to 2% and supply chains recover, things will come back into balance. But we have a long way to go. On housing, we have a dearth of housing in the United States, and so getting that demand and supply back in line with the demand is something that fiscal agents, local communities, not the Fed, will have to work on. And it's a little harder when we have to have interest rates high. I get that, but those are the kinds of things we'll have to work on if we're going to truly come out of this period and get to a point where there's more balance.
And in the inflation articles I've written, gasoline and eggs seem to be the pain points.
Yeah, I mean,
for whatever reason.
I think I asked somebody why eggs, and he said, eggs are a sign that I have enough. Gasoline is a necessity. Eggs is a sign I have enough. If I only can feed my family like rice, potatoes, other things, and I can't feed them eggs for breakfast, I feel like I'm not. That's a takeaway for me in a real sense. And I think that's true. I mean, it is one of the things that people count on.
I have another question.
Hi. Before I start, I came in here with one phone. Somehow I now have two. So one of you is short a phone. So see me before you leave. Hi. So last year, inflation accelerated very quickly, and as a result, real wage gains were negative. Not surprising. This year, we have tight labor markets. We have inflation falling, a result of monetary policy. But we have perhaps large demands by labor for a catch-up so that they get their share of income. My question, and I cite, for example, the auto workers asking for 10% per annum over the next 4 years. My question to you is, are you concerned that inflation expectations are going to embed, just as we have a very tight labor market and interest rates coming down?
Sure. That's a great question. And it's one of the things we focus on, inflation expectations. So let me start with inflation expectations, and I'll talk about how they might change. So throughout the tightening cycle, throughout the high inflation period, and when we had to tighten, long-run inflation expectations. So we asked surveys of businesses, consumers, market participants, all different surveys for long-run, medium-run, short-term. Long-run stayed very stable around 2%. Medium run came up a little bit, but really started to stabilize right when we started the tightening cycle and is around 2%. It was those short run expectations that really ran up rapidly. And those are the ones, when we did analysis, that really feed into wage demand. So people say inflation's this today, and I want these wages to try to pay for that. So the good news that I've seen is that short run inflation expectations have really come down in the last year. They've really come down from their peaks, and the latest surveys are telling us they continue to come down. Now, that is good for wage demands. So for union workers, like the ports did this, the railroads did this, the writers have a different issue. They're on AI and job rearrangement. But those workers, their contracts don't come up all the time. So they're still under a contract while all this high inflation is happening. But unions represent a minority of workers in the United States, and many workers were doing this negotiation in real time. As the inflation was coming up, they were asking for things. As their short-run inflation expectations come down, I would expect the vast majority of workers who are not renegotiating their contracts to continue to have lesser wage demands. But that's an expectation. So then we ask employers, what are you hearing this year? What are the demands? What do you expect to give? And we're seeing not just wage growth currently moderating, but expected wage growth moderating, not back to 3%, which is where it was before the pandemic, but not at 5 or over 5%, which is what it was in just the last year. So we're seeing those wage expectations and the expectations firms have about the wage gains they'll give to be moderating as inflation comes down and the economy cools. And also the labor market's tight, but it is cooling. It's cooled. I mean, we were adding over 300,000 jobs per month against 100,000 new and re-entering workers, and now we're adding about 150,000 a month against that 100,000. So the data I'll be watching, really to ask when do I fear these could be changing, do energy price run-ups or increases, do they start to factor into short-run inflation expectations again and push it up? So I'm watching that carefully. I'm watching does the labor market continue to slow, or does it stabilize at this level, which is not sustainable, or does it go back up? And then the third is what's happening to inflation in general, because that inflation actually feeds into short-run inflation expectations. So all of those are part of the recipe or the data dashboard we'll be watching. But right now, I don't have any indication that short-run or long-run or medium inflation expectations that the recent inflation we've had have been embedded into those expectations. They seem to be behaving in a way that suggests inflation expectations are well anchored and short-run are responding as the data comes in.
Thanks. Any other questions? We got another one?
Thank you so much, and I really want to thank GPL for having this. Hopefully it can become an annual event and have you come back to visit us. I had a question. As a co-owner of a small community bank, we're seeing a proliferation of credit funds becoming alternatives to some of our customers. What does the Fed think about private credit? How do you monitor it? And what's your thoughts on it in terms of the health, particularly at the lower middle market segment?
Sure. So the first thing I'll say, and I think you've heard Treasury Secretary Yellen and Chair Powell, Vice Chair Barr, Michael Barr, who's the Vice Chair of Supervision for the Fed, say that banks of all sizes are an important component of the American financial system. So it's really important that we have a healthy and distributed financial system. It's important that we have banks of all sizes contributing to that. But there is this fact that's occurring that non-bank financials are coming in to the marketplace and offering financial intermediation to consumers. And that used to be really for businesses, but now it's becoming part of a retail element as well. So the Federal Reserve and the other regulators, we regulate and supervise banks. The Board of Governors regulates banks and puts teams in the field to supervise those banks. But we don't have regulatory authorities over the non-bank financials. So we're in a place of studying that, understanding that, and importantly, understanding where our policies on community banks and other banks would interfere with their continued health. But that's why you see so much focus on what can we do with our regulatory and supervisory policy to ensure that we have a safe and sound banking system in a way that ensures that banks can continue to intermediate in the way that's so important for our economy. So we have to balance those two objectives. And when I say we, I mean actually them, because Michael Barr and the regulators do that. Just another part of Fed history, Federal Reserve banks, the regional banks, we don't play a role in regulatory policy. That gets done in D.C. through the Board of Governors, and they also set the supervisory standards. So our job is to take the information back from community banks and other banks and bring it back to them so that when they're thinking about this policy, they're thinking about how do we make sure we have a safe and sound system so that all Americans can feel secure and do it in a way that continues to preserve the great heterogeneity we have in our financial system.
By the way, how many economists do you have in San Francisco working for the Fed?
You know, at the
or the staffing in general?
So we have about 2,000 approved positions at the Fed, but we have a vacancy rate. So I think right now it's 1865, something like that. I can't remember exactly. I mean, this is how employers work. You have this many, and whether you hired this person or not, I don't remember. But but economists make up a very small fraction of that. The whole research department's about 70 people, and that is all the information technology people, the research assistants, all the young people, the interns, et cetera. So, but we have a powerful group, so they can do a lot with few people, and really the bulk of the employees we have, this might be a curiosity to some of the guests, the bulk of the people we have working in Federal Reserve banks or even mostly the regional banks are doing cash processing, doing law enforcement to protect the cash and our other assets people, and then also our supervision and credit function and our information technology function, because so much of how we do well with the payment system and the banking system is through technology, and like other employers, we have great cyber risk and other things, and so we have to really be thoughtful about that. So that's the bulk of our employees. Economists are a small but mighty group.
You have another question?
First of all, thanks, Mary, Russ, putting this on. This is a great forum. Appreciate the opportunity to come up and ask questions. So my question is concerning with consumer credit card debt. Essentially, we understand inflation causes people basically not to have enough cash and have to actually push the credit cards as a component. So interest rates seem to have been basically shooting up in the credit cards even higher than the conventional banking standards. So my wonder is what the Fed thinks about potentially the residual of the credit card debt that's going to go out this unsecured credit. We're at the highest credit card debt in the history of, I think, of the United States, if I'm not correct. So just if you could comment about that, I'd appreciate
Sure.
it.
So the way that I like to look at the information here is to do things in terms of shares and percentages relative to other times. So one thing that's true is there's two things that are true that are relevant. One is credit card debt is starting to rise, and delinquencies in credit card payments are starting to rise. But if you look at where they are relative to previous periods of history, they're still very, very low. So credit card debt as a share of the economy is very low relative to previous times when credit card debt was more worrisome. So even though the debt and the delinquencies are rising, they still are at very low levels relative to the past. So there's something we need to watch, but why? So then you ask, why are they low relative to previous periods? Because households had a lot of excess savings. They had not only and the labor market's strong. So you come out of the pandemic and you have excess savings, either because you received fiscal support or because you continued to work and earn money and didn't have very many things to spend it on. You can only have so many Pelotons. So you saved money. So consumers had a lot of excess savings and they spent that down. And we still have some out there, but it's going down. But you spent that down before you used credit cards. We're starting to see credit card debt being used and those delinquencies rise, especially what worrisome for the low and moderate income individuals who are maybe using that out of the necessity. But so far, not at worrisome levels, just something to watch.
That said, average credit card rates of about 20% are mind-boggling in a sense.
It's like mortgages back in the 70s. Not quite that high, but still pretty high.
Let's take a moment as we conclude and thank Russ and Mary for a really interesting program. If you're watching on the telecast, and even for the folks here, if you want to follow what's happening in a lot of Arizona business, then look up Russ. I'm sure he's on all of those little social media platforms that tell you everything that's going on every day. And the same for the Federal Reserve. Thank you very much, Mary, for making the trip down to Phoenix. I want to thank Shannon Smith and all of his team from the Fed that worked with the team from GPL, who is all here. Everyone did a really great job. Thank you all very much for all of your work. I want to thank Mia Parrish and the folks here at Arizona PBS. They wouldn't let us put a real fireplace here for a fireside chat, but I'm sure there were some code issues with that, so we're fine with that. And then I understand Supervisor Clint Hickman has also joined us during the program, in addition to the elected officials I mentioned at the beginning. Thanks to all of you who came here today. Thanks to all of you who are watching online, and we'll be able to watch this again if you would like. So you can continue to get this information and share this information with people in all of your organizations. And with that, on behalf of Greater Phoenix Leadership, we thank you all for being here and have a great day and a great weekend.